On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Sam Stovall. He is the Chief Investment Strategist at CFRA Research. Sam, we are at the start of the earnings period and third quarter earnings. So what are the early reports telling you compared to, say, Wall Street expectations?
Hey, Todd, good to talk to you again. Well, basically, nothing new in the sense that actual results have exceeded end of quarter estimates in 63 of the last 65 quarters. And we're doing it again this time, with more than 20% of the S&P 500 having reported so far. We are finding that about 75% of the companies are beating expectations. So there's good performance on the top line, on the bottom line. According to S&P Capital IQ consensus estimates, now we're likely to see an 8% increase in Q3 earnings versus the 6.9 projected at the end of the quarter. And the best upward revisions were to financials. They were expected to be up 8.9. Now the forecast is 18.2. And
Wow.
tech is holding on to its 20+% growth expectation.
So hold on, let me get this right. 18.2% increase. This is year over year,
Year over
obviously.
year in Q3 for financials
Wow.
versus the 8.9 that was forecast. Really, and it was because the big banks hit the ball out of the park, since we're still in World Series timeframe. And also the regional banks. We had seven report last Friday, and at least five of them posted topping the earnings and revenue forecasts. So basically, we're getting really good returns coming from the financial sector.
So let me ask you this. October's been volatile, as you know, in the markets, which usually is a signal for a healthy trading environment, trading desks inside these bulge bracket firms. With the regional banks withholding those out of this conversation right now, what are your thoughts then for the fourth quarter? I mean, that double-digit increase you would imagine would carry over well into 2026. So now might be a good time to be bullish on the financials?
Well, we've been bullish on the financials for the last couple of years, and that's worked out for us. Yes, we've had interesting anti-seasonal activities so far this year. The market was higher in August and September, 2 months that have traditionally posted declines. So, and now with October, we're still eking out a gain, but October is normally higher. What really is higher for October is the volatility. 33% more volatility in October than compared with the average for the 11 other months of the year. And so we're getting that kind of volatility. But this anti-seasonality that we're experiencing does not tend to steal from Santa, as I call it. Meaning, if you've got a positive August and September, we still, in the fourth quarter, end up with a gain of close to 5% and an 80% batting average or frequency of advance, regardless of whether August and September were good or bad. So I would tend to say that this move in the market is likely to continue through the end of this year.
Well, that's impressive. So far, I have not heard at the post earnings conference calls from companies. I haven't been hearing that guidance that there is a concern about tariffs or even supply chain issues. But I would imagine we will be hearing that as we proceed forward, especially with some of the more industrial companies reporting. But what would you say to investors that need to interpret that guidance? How should they take that if a company does come out and discusses the tariffs and maybe global supply chain pressures?
Well, typically companies are not that forthcoming with guidance, especially in this kind of an environment where they're not really sure whether the tariff impact on inflation is simply delayed or just not going to be existent. So I would tend to say they're going to keep their cards fairly close to the vest. Also, they don't want to get their stock prices beaten up because they either slipped on earnings or had a slip of the tongue when it comes to providing guidance. So I think basically, yes, they might mention it if there needs to be an area for blame, like with Netflix and the Brazilian tax consequences and so forth. So, I would tend to say that the tariffs are likely to be the fallback where if you did want to blame something.
So what should it, as far as asset allocation goes, though? I mean, you're bullish on the markets. I'd imagine you would probably, obviously, the majority of any type of portfolio out there, CFRA is going to say, look at equities, especially the high quality equities. But what about for investors that are looking at different allocations going into 2026? I mean, you have so many other, I want to say they're challenges, but they're definitely concerns when it comes to interest rate fluctuations. You have geopolitical tensions. I mean, there's a number of issues right now, tariffs, as we were speaking of. How should investors really think about allocating, at least over the next 12 months?
Well, I think they should rewatch the movie, the Clint Eastwood movie about where he mumbles, "A man's got to know his limitations," which was Magnum Force. The reason being that we'll be heading into a midterm election year in 2026. Now, challenging on multiple fronts. First off, right now the S&P 500 is trading more than 2 standard deviations above the mean over the last 20 years. So in terms of PE projections, the PE ratio is 42% premium for the S&P 500 and a 63% premium for tech. If you look at Warren Buffett's favorite indicator, which is S&P 500 market cap to GDP, we are now at 190%. And it used to be once you peaked your head above 100%, that was a sign of caution. When it comes to seasonality within midterm election years, of the 4 years of the presidential cycle going back to World War II, the midterm is by far the worst with an average drawdown of 18%. So on average, you see a deep correction take place. And it tends to be magnified when you have a wave, meaning where a Democratic president with a totally Democratic Congress or a Republican president with a totally Republican Congress, because typically you end up losing 20 plus seats in the House and about 4 plus seats in the Senate at midterm election period. And many times those waves tend to go away. So the uncertainty leading up to the midterm elections, I think, will certainly be present. But to put a little bit of a positive spin on the whole thing, from October 31 of midterm election years through October 31 of the third year, the market has never declined since World War II, and the average price gain was 16%. So once the uncertainty of the midterm election period has concluded, then investors breathe a sigh of relief and say, you know what, I don't really care who did get elected. Now the uncertainty is over, and that's when the market tends to take off once again.
So the Halloween to Halloween timeframe, though, that 16%, is that typical of a second term president? I mean, even though President Trump's not in consecutive terms, it still is his second term, though.
You do get a 16% return. That was for all observations.
Okay.
I would tend to say that it's probably a little more muted for second term because they're lame ducks as it is. And there was, in a sense, less at stake with the first term presidency. But still, the results have been positive.
Interesting. So sticking to that theme, though, because Republicans in office have helped, historically speaking, the defense sector. So, what are your thoughts on defense right now? Because there is a lot of talk out of the White House regarding, ordering new missiles. I know there was a report out of the Pentagon, but what's your thought overall, historically speaking? Is now a good time to be thinking about defense, or is it usually after, say, the president leaves office?
Well, no, you're absolutely right that defense under a Republican administration tends to be encouraged by investors. And we've been seeing very strong Q3 results for the industrials so far. GE Aerospace, RTX, Lockheed Martin, all reported stronger than expected earnings and revenues yesterday. We do think that Boeing, because they have been able to increase the number of planes. I mean, they're more commercial rather than pure defense, but still, that group together is likely to do fairly well. Also, our Lowry ETF. Our Lowry technical analysis arm looks to the aerospace defense ETFs and are seeing an improvement in their near and intermediate term relative performances.
Okay. So let's switch gears here then. That's on the defense side. Obviously, a lot of you know, a lot of well, anyway, we'll remove ourselves from that. Let's start talking about the holiday shopping season right now. I want to get your thoughts on retail. I've asked a lot of experts like yourself who come on these shows about now with retail, but you still have consumer pressures. You still feel that the consumer, at least on the lower income scale, is feeling the pressure from inflation and therefore might not be able to spend as much. But with that said, do you still, or would this be a bullish time to be investing in the retail sector?
Yes, we have a five-star ranking on broadline retail, which is uh, where you would find Amazon in particular, and you might think that Walmart would be in that category, but believe it or not, since more of sales are in food, that's why Walmart is in the consumer staples category. But still, consumer staples merchandise retail, which is where Walmart is found, we have a 4.6 out of a five-star ranking. So essentially, our analysts are still very optimistic on both Amazon and on Walmart, also feeling that consumers are still looking to spend. We're looking for pretty strong year-on-year percent increases in the retail sales area. And so as a result, our belief is that there's still upside potential in that category.
So, okay, that's good to hear. That's great for Santa Claus, obviously. So, and as Jeff Hirsch likes to talk about the Santa Claus rally with the Stock Traders Almanac. So, I'd imagine we'll have to wait and see if that's going to happen. I know we missed it this year. Maybe we'll have a rebound this coming year, or 2026. Let's talk about. I'll have gold bugs right now sending me hate mail if I don't ask you about gold. We had a big sell-off yesterday, biggest one-day sell-off since 2013. We have more selling pressure today, with gold and silver being in favor with so many things like the government shutdown that's taking place, and obviously the independence of the Fed being put into play. What are your thoughts on the gold trade right now? Should this be an allocation that investors should consider at least maybe going overweight for the time being?
I think that, when you think about gold, it has no earnings, it pays no dividend, and it is affected by the value of the dollar. Right now, the dollar had been strengthening a bit recently, and investors, I think, just said, you know what, it's time to take some of the profits. And really, all we did was move back down to the 20-day exponential moving average. Didn't even get to the 50-day or the 200-day. And so, based on the move that was made without a lot of stops along the way, not a lot of support levels to hang on to, you could say that the decline could be as much as a 50% retracement from the recent breakout at around $3,300. Uh, so I would tend to say that we could see maybe a pullback to about 38.50. But then I think that unless things change, meaning that the peace breaks out around the world, the dollar strengthens, or whatever, I would tend to say that you're going to probably see another rally and attempt to break above the prior high, with the older forecasts of $5,000 being something that is likely to be met sometime in 2026.
Wow, that is great. That sounds like a breaking news story right there. $5,000. I know some strategists have also said that, but I haven't heard it recently. So that's great for gold enthusiasts, that's for sure. One question on real estate. You had obviously the Fed cutting rates. I know the Fed is meeting next week. Not quite sure how they're going to be able to come up with a decision without receiving any data, but that's beside the point. On the real estate side, we have seen rates come down a little bit on the long end of the curve. You would hope that that would help stimulate the real estate sector. Would this be a good time to start focusing on the real estate sector for a portfolio?
Yeah, real estate has not done all that well this year, with the market itself up more than 13%. The real estate in the REIT area is up less than 2.5%. I think that your question is sort of a compound question in that, what about home building? We don't are not optimistic on home building in the near term, and it's not because of the real estate loans and the interest rates and mortgage rates, et cetera. It has more to do with the supply out there and the concern that investors might have, or just general Americans might have, because of the softening labor condition. When looking, however, at the REIT area itself, our belief is that many of the more industrial areas, in particular the self storage, could look relatively good. I would tend to say that we have four-star rankings for the healthcare REITs and the hotel and resort REITs, because people still want those experiences. But in general, the remainder of these REIT categories are at hold or even slightly lower ratings.
Okay. Okay. I have one final question for you today. You're a Wall Street legend. When it comes to investment research, you're definitely the GOAT out there. And I know I'm not alone in saying this. So my question for you when it comes to AI, are you now using AI to help with your forecasting?
I am. I've been one who looks at fundamentals, who looks at technicals, but at the same time, I am not a department of my or a company of my own. I work with our equity analysts and the stocks that they follow. So I will look at the target price differentials that our analysts have for the stocks in the S&P 500, which are typically 12 months out. I do take a look at point and figure forecasts for stocks in the major indices to say where might we end up seeing these stocks a year from now. But then I do look to history, because history, it might not rhyme. Might not repeat, but it frequently rhymes. And I tend to say that I am a bit worried right now about the midterm election years. So we do use AI in terms of helping the analysts with forecasts and so forth, especially as it relates to the economic underpinnings of their sectors and sub-industries. And in a sense, I am therefore reliant on their forecasts from a fundamental perspective that I overlay with technical and historical precedent.
That makes a lot of sense. And I'd imagine that it's used as a tool. I mean, you're just now able to give out even better research, and obviously the data points are that much better. So that's great to hear. Sam, I want to thank you so much for joining me today. I know we're going to have you back probably a few times before the end of the year. So I'm not going to ask you your 26 forecast yet, but I'll give you some time to think about it a little bit longer. But I do
Sounds
appreciate you joining me.
And I'll leave you with one positive thought. If we do end up with a decline between now and year end, we have never had a calendar year that started with a deep correction as we did this year, that then ended up with a correction or a decline that went further than 10%. So, a pullback could certainly be possible, but the average has been only 8.5%, and it never went beyond 10%.
So what happens then the following year then when we do experience what we saw this year?
Well, the following year, we do end up seeing the potential for an even deeper decline, as I mentioned, because of
Oh,
a lot of the corrections that we saw in the late 1990s were sort of like a prep for the final big one, as Red Fox used to say. So, I would tend to say, be careful. Don't assume that the stock prices are growing to the sky. Don't back up the truck. Just be, very careful about what you do end up buying.
So it could be a pearl clutching moment then, is what you're saying. So we'll keep an eye out.
It could be, if nothing else, then at least volatility, if not overall decline.
Okay. All right. Well, we'll definitely keep it in mind and we'll follow up with this conversation, obviously, as we get closer to the end of the year. So, Sam, thank you once again for joining me today. Definitely had a
Pleasure.
great conversation.
Thanks, Todd. Always a pleasure.
Absolutely. So, on behalf of Sam Stovall, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up tomorrow, we have congressional candidate Bernie Flowers is joining me for a one-on-one exclusive. He just announced his 2026 candidacy, and you definitely will want to hear what he has to say about the government shutdown. He has some stuff you have not heard yet, some inside baseball stuff. And Jay Halfield's joining me tomorrow afternoon as well, live, so definitely don't want to miss out. So I appreciate it, and we'll catch you next time. Take care now.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.